If you are over 50 and staring at your retirement number with a sick feeling in your stomach, I want to begin by telling you something the financial world does not say often enough. You are not too late, you are scared, and perhaps for good reason. You may have started late. Life may have interrupted the clean, elegant plan the books like to describe. Children came, medical bills came, a job loss came, a divorce came, parents aged, a business failed, a decade disappeared in survival mode. Then one day you looked up and all the cheerful advice seemed to be written for a 25-year-old who still had 40 years, perfect health, and plenty of optionality. That is not your life. And if that is not your life, then advice built for that life is not enough. I know how this feels. The public imagines that money problems only belong to the careless. That is nonsense. A great many careful, honest, decent people reach their 50s carrying an invisible burden, not just the burden of insufficient savings, the burden of comparison, the burden of time, the burden of wondering whether the game was already decided while you were busy living. That is the part that makes a person feel helpless. Every article says start early. Every calculator shows what would have happened if you had invested steadily from age 25. Every chart becomes a small insult. You do not need more insults. You need a structure. You need something strong enough to grow what you have left and stable enough that one bad sequence of market years does not destroy your confidence right before retirement. That is the real problem for a person over 50. Not how to become rich overnight, how to build offense and defense inside the same machine. Most people over 50 do not need a dozen exciting funds. They do not need to become stock-picking geniuses. They do not need a heroic narrative about outsmarting the market. They need a portfolio that can still grow, because retirement may last 20 or 30 years, and inflation will not politely stop when your paycheck does, but they also need a portfolio that can protect them, because a brutal market decline a few years before retirement can do emotional and practical damage if the structure is wrong. That balance matters more than almost anything else. If you are too aggressive, you may suffer a drawdown you no longer have the time or stomach to endure. If you are too conservative, inflation will quietly steal the life out of your savings while you congratulate yourself for feeling safe. That is the trap. Too much offense, and you panic, too much defense, and you decay. What you need is a partnership. One piece that keeps the money working, one piece that keeps the person stable. If I had to build that partnership for an ordinary American over 50 using only two funds, I would not make it complicated. I would use the Vanguard Total Stock Market ETF, ticker VTI, and the Vanguard Total Bond Market ETF, ticker BND. That would be enough, not because two is magical, because the right two, used correctly, can do far more than a cluttered collection of half-understood products. Now, before you dismiss simplicity as a sign that the answer cannot possibly be sophisticated enough, let me say something I have learned after a lifetime of watching investors hurt themselves. Complicated does not mean intelligent. Very often complicated simply means harder to hold, and the right portfolio is not merely the one that looks best on a spreadsheet. It is the one you can actually keep through ugly headlines, frightening drawdowns, and the emotional distortions of aging. A good portfolio must survive not only the market, it must survive you. That is a harder test than many people realize. So let me begin with the growth engine, VTI. When you buy VTI, you are not buying one fashionable stock. You are not betting that you have identified the next technological monarch. You are not telling yourself that one industry, one trend, or one charismatic founder will carry your entire future. You are buying a broad claim on the productive output of American business. Thousands of companies, large ones, medium ones, smaller ones, technology, healthcare, industrials, consumer companies, financials, energy, transportation, and everything else the country produces through public enterprise. That matters because the American economy is not one story. It is many stories running at once. One company stumbles, another rises. One sector slows, another strengthens. Leadership changes, the broad machine keeps moving. That is what I want for the over 50 investor. Not dependence on one stock, not dependence on one narrow theme, a broad productive engine. People underestimate how much psychological strength comes from not needing to guess the exact winner. The younger investor sometimes confuses concentration with courage. The older investor should know better. By the time a person is over 50, he should be far more interested in getting paid for being broadly right than in trying to look brilliant by being narrowly lucky. That is what VTI offers. You own the market's natural selection process. The stronger firms become larger components over time. The weaker firms shrink or disappear. Innovation still enters the portfolio, but you do not have to predict its exact shape in advance. That is a beautiful design, and beauty in investing often looks boring from the outside. I like boring compounds. Boring lets people sleep. Boring keeps people from doing theatrical things with their retirement money. Now let us talk plainly about why VTI matters even if you are over 50 and feel time is short. People tell themselves that because they are closer to retirement, growth is no longer necessary. That is a dangerous misunderstanding. Unless you plan to die on schedule and exactly on budget, growth still matters. A person retiring at 65 may easily need the portfolio to work for another 20 or 30 years. That is a very long time for inflation to chew through purchasing power. A portfolio with no growth component is not conservative. It is exposed. It may feel calm for a while. But a calm decline in real purchasing power is still decline. VTI helps solve that problem. It gives the portfolio a living growth engine. It allows your capital to keep owning businesses that can raise prices, expand earnings, buy back shares, pay dividends, and continue participating in the productive side of the economy. That is how a retirement portfolio remains alive instead of turning into a shrinking storage unit for old dollars. There is another reason I like VTI. It is cheap in the right way. The expense ratio is tiny. That matters more than most people emotionally appreciate. People focus on market return and ignore the slow tax of fees. Fees are termites. They do not usually blow the house apart in one loud afternoon. They quietly eat the frame. A broad index fund with minimal expenses lets more of the market's actual returns stay with the owner. That is exactly what I want. Especially for a person over 50, you do not need the additional drag of a complicated active product charging a premium for ordinary results. You need a low-cost mechanism that turns the work of American business into your own future security. VTI does that, but VTI alone is not enough. That is where younger investors often get arrogant and older investors often get hurt. A one-fund stock only plan can look genius in a long bull market. It can also become emotionally devastating if the market cuts deeply. Right before the years when you need the money, this is not theory. Sequence risk is real. The order of returns matters. A 30% drop at age 30 can be unpleasant. A 30% drop at age 62, when retirement is near, can change actual life decisions. That is why the second fund is not optional. BND is the second fund. The Vanguard Total Bond Market ETF. This is the part people over 50 most often misunderstand in one of two directions. Some dismiss bonds because they look at past low return years and conclude bonds are dead, outdated, and only for timid people. Others hide in bonds and cash because fear tells them that growth is now too dangerous. Both groups are wrong for the same reason. They are thinking emotionally instead of structurally. Bonds are not there to excite you. They are there to stabilize the machine. They are there to absorb some of the shock when stocks become violent. They are there to throw off income. They are there to give you something to rebalance from. They are there to buy time. Time is one of the most underappreciated assets in retirement planning. A person with no stabilizer is forced to experience the full emotional violence of the stock market. That full experience often leads to selling at the exact moment that patience was needed most. A person with some real bond exposure does not eliminate risk, but he changes its shape. The drawdowns are softer, the income is steadier. The portfolio behaves less like a race car and more like a durable vehicle meant for a very long trip. That is appropriate. And remember what BND actually is. It is not junk. It is not some speculative credit product packaged to look safe. It is a broad collection of high-quality bonds, largely treasuries and investment-grade debt. Thousands of holdings, government-backed exposure, strong corporate issuers, a wide base. Again, broadness matters. I do not want the over 50 investor hunting for yield in strange corners just to add another half point of income while increasing fragility. I want structure. I want resilience. I want high enough quality that the bond sleeve can actually do its job when equity markets are misbehaving. Now let me tell you why I think most people over 50 get the second fund wrong. They understand that a stock fund grows fine, but they treat the bond fund as a dead weight instead of as a behavioral stabilizer. That is a major error. The public likes assets that impress them when markets are calm. I like assets that keep people from self-destructing when markets are not calm. BND is not merely there to produce a number. It is there to change your behavior. Imagine a serious market decline. Headlines everywhere. Friends calling, retirement accounts bleeding, panic in the room. If all you own is VTI, your portfolio is telling one story: pain, pain, pain. Even if that pain is normal and temporary, it feels absolute in the moment. Now imagine the same decline, but 40% of your portfolio is in a broad, high-quality bond fund that is holding up much better and throwing off steady income. Now the story is different. You still feel pressure, but you do not feel annihilation. And because you do not feel annihilation, you do not behave like a hunted animal. That is the entire point. The best portfolio is not the one that makes the boldest promise. It is the one that lets you remain rational. Most investment failure is not analytical. It is behavioral. People know they should stay invested. Then the account falls enough and the nervous system takes over. BND gives the nervous system something to hold on to. That is worth more than many people know. It is also useful because of rebalancing. A proper two-fund structure creates its own discipline. If stocks run too far, you trim VTI and add to BND. If stocks fall hard and bonds hold up relatively better, you trim BND and add to VTI. That means the portfolio teaches you to do one of the hardest things in investing. Sell a little higher, buy a little lower, not through courage, through structure. That is why I like rules. Rules are what you use when your emotions cannot be trusted. And emotions cannot be trusted when money and age start colliding. So now you have the two pieces, VTI for growth, BND for protection, offense and defense. But how much of each? This is where most people want a perfect answer. There is no perfect answer. There is only a sensible framework. I like the rule of 110 for a reason. Take 110 and subtract your age. That is the approximate percentage that goes in stocks. The rest goes in bonds. 50 years old, 60% stocks, 40% bonds. 55 years old, 55% stocks, 45% bonds. 60 years old, 50% stocks, 50% bonds. It is not a law of nature. It is a simple glide path, and simple glide paths tend to work better than elaborate plans people do not follow. A glide path matters because life after 50 is not static. You are not building one portfolio for one day. You are building a structure that should gradually shift from heavier offense to greater stability as your need for immediate durability increases. This is one reason I prefer rules to moods. A person who waits to feel ready to become more conservative will usually do so after a frightening event, which means he is letting the market choose his timing. I do not like the market choosing my timing. I like design. Let the allocation adjust on purpose. That is much stronger. Now, let us speak in real numbers because abstractions can only go so far. Suppose you are 50 and you have $100,000, $60,000 in VTI, $40,000 in BND. And let us assume a blended return that is realistic, not theatrical. Something like 9 or 10% in very good periods across the stock sleeve, lower in bond periods, and a blended total that is materially above cash over time. The number grows more than most frightened people think. 10 years later, it is no longer 100,000 unless you sabotage the process. 15 years later, it can become something that meaningfully changes retirement quality, not because one year was magical, because the machine worked. That is the whole idea. People over 50 often think the missing years mean the remaining years do not matter enough. That is the wrong conclusion. The remaining years matter even more because now every decision has greater leverage over a shorter but still meaningful runway. The absence of perfection is not an excuse for disorder. A person starting at 50 still has enough time for growth to matter and enough need for protection to require seriousness. That is exactly why this two-fund structure works so well. It respects both truths at once. Now let me speak to the person who does not have 100,000. Maybe you have 10,000, maybe 5,000. Maybe a few $100s a month. You could begin directing better if you finally built the structure. That does not change. The logic is the same. The numbers scale. A person who invests $300 a month into a sensible two-fund structure is not doing something small. He is buying his future with regularity. That matters enormously. The market does not care whether your first contribution was glamorous. It cares whether you stayed in the process long enough. And for the over 50 investor, that is especially important. Because the late starter is more vulnerable to one particular kind of psychological poison, the poison of self-disqualification. I started too late. The amount is too small. It will not matter enough. That poison keeps millions of people in cash while inflation quietly robs them. The amount matters less than the architecture. A weak architecture with a larger balance can still fail. A strong architecture with a smaller balance can still grow meaningfully. What matters is that the person begins, and once he begins, that he stops treating the portfolio like a slot machine. This is where the biggest mistake shows up, not in picking the wrong two funds, in checking the account too often and reacting emotionally to what he sees. I cannot say this clearly enough. A proper two-fund retirement structure is not designed for daily observation. It is designed for long stretches of quiet discipline. If you check it every day, you turn investing into weather watching, you become moody, you become reactive, you start making tiny emotional decisions that feel harmless until enough of them pile up and weaken the entire machine. The public wants activity because activity feels like control in investing. Activity often means interference, and interference is how sound strategies die. Once you have the allocation, your job is not to reinterpret it every week. Your job is to fund it, leave it alone, and rebalance periodically. That is all. One rebalance a year is enough for most people, maybe twice in unusually distorted markets. But the whole point is to let the design make most decisions for you. If the stock sleeve outgrows its role, trim it. If the bond sleeve becomes too heavy because stocks suffered, rebalance back into stocks. That is the job. Not guessing elections, not reading tea leaves in Federal Reserve speeches, not asking whether this one quarter means everything must now change. The portfolio already knows its job. You do not need to keep rewriting the instruction manual. This is also why I do not want the over 50 investor building a zoo. Too many funds create confusion. Too many funds create stories. Too many funds create the feeling that because the portfolio looks more sophisticated, it must be more intelligent. Often the opposite is true. A crowded portfolio becomes harder to understand, harder to rebalance, and easier to abandon emotionally because there are too many moving parts to trust. Two good funds can do more for an over 50 investor than 15 half. Understood ones, simplicity is not weakness. It is strength you can actually maintain that matters, because maintenance is where the real return comes from. The world likes novelty. Retirement does not need novelty. Retirement needs reliability. Now let me say something about fear. A lot of people over 50 are not bad investors. They are scared investors. That is very different. They are scared because they know they do not have the full runway a 25-year-old has. They are scared because the cost of being wrong feels larger. Now they are scared because they do not want to tell a spouse or a child or themselves that the years were mismanaged. So what do? They hide in cash, they delay, they watch. They tell themselves they will invest after the next correction, or after rates change, or after the election, or after the market becomes more stable. The market laughs at that kind of waiting. Stability is most obvious after prices have already moved. This is why structure beats mood. If you already know the two funds and the allocation, then you do not need emotional courage every single month. You need a calendar, a schedule, automatic contributions, a rule. That is what protects frightened people from frightened decisions. The frightened over 50 investor does not need a braver speech. He needs a portfolio that reduces the number of heroic choices required. That is the kindness of simplicity. Now, because I know some people watching this think bonds are dead weight and others think stocks are now too dangerous, let me put both objections to bed. To the person who says bonds are pointless, I say this. Tell that to the retiree who needs to draw income during a stock crash. Tell that to the investor who panics and sells because he built a portfolio with no stabilizer. Tell that to the person who suddenly needs to rebalance into cheap equities but has no dry powder because he decided all defense was cowardice. Bonds are not there to impress you. They are there to keep you in the game. And staying in the game is the whole thing. To the person who says stocks are too dangerous, after 50, I say this. Inflation is also dangerous. Longevity is also dangerous. Retiring at 65 and living into your 90s with a portfolio that never grows enough to keep up with the real world is another kind of disaster. Safety that shrinks in real terms is not true safety. You need a living engine. That is what VTI is doing in this structure. This is why the partnership matters. Too much stock and you may not endure the ride. Too much bond and the money may not endure the decades. A well-chosen blend gives you the chance to survive both volatility and erosion. That is the balancing act. And retirement investing after 50 is a balancing act much more than a performance contest. I have no interest in winning performance contests with retirement money. I have interest in building structures that can hold under pressure. There is another benefit to this too. fund approach that the public rarely discusses enough. It restores dignity to the process. A person with 15 different funds often is not diversified in any useful sense. He is confused, he is performing intelligence, he is signaling engagement. A person with a clear two-fund plan, a sensible age-based glide path, a rebalancing rule, and automatic contributions is not confused. He knows what he owns, he knows why he owns it, he knows what each piece is supposed to do. That is dignity. Dignity matters because a person who understands his own financial structure behaves with more confidence and less panic. That alone can add enormous value over time. Most underperformance does not come from having the wrong idea. It comes from interrupting a decent idea badly enough that it never had time to work. I want people over 50 to stop interrupting themselves. That is one reason I like VTI and BND together so much. They do not require you to become an amateur economist, a market prophet, or a fund collector. They require something much more useful: patience, consistency, periodic maintenance. That is enough. If you want to improve your odds even further, then lower fees wherever you can. Avoid unnecessary debt. Keep a separate emergency reserve so you never need to raid the portfolio during a bad market. And stop letting the account value determine your emotional weather on a weekly basis. These are not glamorous instructions. Good. Glamorous instructions usually sell better than they work. The truth is that most people over 50 do not need more stimulation. They need less interference. If you build the structure correctly, then your job becomes smaller. Earn, save, fund the two sleeves. Rebalance annually, ignore the noise. Let time and discipline do the heavy work that excitement never could. That is what I would want for an ordinary American over 50. Not a miracle, not a fantasy of catching up in 1 year. A durable structure strong enough to grow what remains and stable enough to protect what matters. That is what retirement planning should be. Not theater, not guilt, not endless comparison with younger people who had different timing structure. You cannot change the years behind you. No one can. But you can change the design of the years in front of you. And if you do that well enough with enough consistency, the future can still feel far better than the fear in your stomach is telling you right now. That is not false hope. That is just what happens when sound structure finally replaces financial improvisation. I have always trusted sound structure more than inspiring language. Inspiring language fades quickly. A good structure keeps working. That is what makes it worth building. That is why I would use VTI and BND. Not because the names are magical, because together they solve the central retirement problem over 50 better than most complicated portfolios ever will. One fund grows, one fund protects, one fund fights inflation and time. One fund fights panic and bad timing. Together, they give an ordinary person a fighting chance to retire with something more valuable than just a bigger number. Calm. I have always thought calm was one of the best returns money could buy. And a proper two-fund structure gives you far more of it than the average person realizes.